Good morning, ladies and gentlemen. Welcome to the SGX FY 2021 results briefing. The agenda for this morning will be as follows. First, a presentation of our financial highlights and performance by Ng Yao Loong, our CFO. This will be followed by a business update by our CEO, Loh Chai. We will then end off with a question and answer session with a panel comprising senior executives from SGX. For those of you who are viewing this briefing through webcast, you may change the resolution of the broadcast to a higher setting if the images are not clear. The settings can be found at the bottom right of your webcast window. So without further delay, let me now invite Yao Loong to deliver our financial highlights. Yao Loong, please.
A very good morning, and thank you for taking the time to join our FY21 full year results briefing. SGX achieved a strong performance in FY21 as we invested in growing our business. We accomplished a similar record revenue performance as FY20 at almost $1.1 billion amidst a challenging environment. One major challenge, which we have outlined before, is the prolonged low interest rate environment. It is an exogenous factor that has affected our treasury income, or TI. So if we exclude treasury income, which the blue columns show, underlying business revenue was up 7%, which demonstrates the strength of our platform. This is in part also driven by the revenue contribution from our two recently acquired subsidiaries, Scientific Beta and BidFX. When we look at total expenses, it is useful to separate out the expense contribution from the two subsidiaries and the underlying core business. SGX is no longer a monolithic entity, but a combination of strong core businesses and growth engines. So if we exclude the two subsidiaries, our underlying expenses actually declined 4%. This shows our discipline in maintaining the cost base of our underlying core business, which then allows us to invest for growth. This is also fairly evident when we look at the EBITDA margins, excluding treasury income and the two subsidiaries. The EBITDA margins of our underlying core business improved by 1 percentage point. What this slide shows is the breakdown of our revenue growth by two segments, our underlying core business and the two subsidiaries, Scientific Beta and BidFX. As you can see from the top half of the page, combined revenue from Scientific Beta and BidFX came in at $75 million, which is about 7% of total revenues, an increase from the 6% we disclosed in our first half of financial year 21. And with the addition of MaxxTrader, the proportion of revenue from our fast growth subsidiaries would exceed 9%. As for our underlying businesses, which is in the bottom half of the page, FICC and cash equities were the main revenue growth drivers. FICC revenue increased $10 million as total commodities volumes rose 3% to 25 million contracts. In commodities, we maintained near 100% market share of the offshore iron ore market. Financialization efforts are making good progress. Screen trading now contributes about 20% of iron ore volumes, and contribution from the T+1 session has increased to 15% of total volumes. Freight volume was up 42%. Market share exceeds 60% as we continue to be the platform of choice for clients in a pandemic-led supply-constrained environment. As for currencies, while volumes were comparable year on year, we continue to lead in terms of market share for our key contracts. Market share for our rupee contracts rose 12 percentage points to 69%, while CNH was comparable at 83%. With the addition of BidFX and MaxxTrader upon completion, the FX franchise comprising both OTC and exchange-traded futures will be a key growth driver. Revenue for cash equities increased $15 million due to higher trading revenue, settlement activities, and corporate action. SDAV increased 2% to a higher and sustained level of $1.35 billion. We saw a wider group of participants, including retail investors, market makers, and active traders, Retail value traded grew almost 40% year-on-year. Turnover contribution from ETFs grew almost 20% during the year, with the launch of 4 new ETFs. This continues to look promising as we see a strong pipeline of new ETF listings in the year ahead. Average clearing fee for securities was comparable at 2.68 basis points. Our equity derivatives business demonstrated its resilience as the franchise rebounded in the second half of FY21, following the successful liquidity switch to the FTSE index series in the first half. Overall, volume declined 6%, mainly impacted by the lower Nikkei volumes. But what is more important is that our network and portfolio effects of our platform remain intact. Our flagship China A50 and Skimsky contracts saw a volume increase by 8% and 4% respectively, while the yield from these products were higher. Overall clearing fee for equity, currency and commodity derivatives was comparable at $1.34. The average fees for the second half was higher at $1.40 compared to $1.27 in first half. Our average fee in first half, as you are aware, was lower, largely due to the implementation of introductory fees for the FTSE Asian Expansion Suite. As for DCI, revenue for the underlying business, that is excluding Scientific Beta, was comparable. The addition of Scientific Beta contributed an additional $21 million of revenues to the DCI business segment. Scientific Beta's assets under replication, or AUR, has now exceeded $60 billion as of end FY 2021. It has expanded its solutions beyond smart factor strategies by adding a new climate index solution. The main drag to our revenue is the decline in TI. While average collateral balances have increased year-on-year, the low interest rate environment has and continues to weigh on our treasury income. So if I can sum this revenue slide, operating revenue from the various businesses has remained strong. Excluding treasury income, business revenue was up 7%. And even if we further exclude the revenue contribution from the 2 subsidiaries, revenue from the underlying core business remained comparable year-on-year. Moving on to expenses, which on a headline basis increased 8% year-on-year. The increase has been driven by the investment for growth, underpinned by cost discipline in the underlying core business. Let us first take a look at the expense profile of our underlying core business, which is shown in the bottom half of the page. We see a year-on-year decline of 4% to 458 million from 475 million. The decline was mainly due to a few factors. $11 million lower depreciation expenses, $10 million lower staff costs and absence of one-off costs relating to the SGX care package incurred a year ago, and $4 million decline in discretionary costs, mainly due to lower marketing and travelling. Processing and royalties increased 8% or 16% due to higher royalties incurred for key contracts and the launch of new contracts as part of our FTSE Asian Expansion Suite. This was partially offset by a decline in royalties incurred from contracts with lower volume. The expense decline in the underlying core business has allowed us to create the capacity to invest in Scientific Beta and BidFX. Collectively, both contributed to an expense increase of $55 million. And if you compare the revenue and expense contribution, both subsidiaries are profitable. I've mentioned a few weeks ago at the Analyst Day presentation that we would see higher total expense growth in the near term as we continue to invest in our faster growing businesses. However, in the medium term, I would like to reiterate that we do expect expense growth to moderate to the mid-single digit region as we build scale. Similarly, margins, be it EBITDA or operating, have been impacted in the near term because of 2 reasons. One, our faster growing subsidiaries have lower margins. Scientific Beta and BidFX combined have an EBITDA margin of 37% on a standalone basis. Second, the decline in TI has a disproportionate impact on margins. This is because a dollar decline in treasury income reduces EBITDA and operating profit by $1. In other words, it is a direct drop through to the bottom line. In order to have a better appreciation of the operating leverage of the underlying core business, we should exclude TI and the two subsidiaries. And if we do so, the underlying EBITDA and operating profit margins would have gone up by 1 percentage points and 2 percentage points respectively, year on year. Margins will recover as we maintain cost discipline and build up our growth businesses such as FX. TI or treasury income will continue to weigh on our margins, but over the medium term, I expect margins to recover to levels of FY20. Looking forward, as we continue to invest for growth, we expect total expenses in the new financial year, FY22, to be between 565 million to 575 million. Let me explain the nature of the expense growth. From the chart, you will note the expenses will grow 9% in FY22, if I use the midpoint of the range. But more than half of this increase will be for growth. A total of 5 percentage points for growth in the underlying core and subsidiaries business, of which 2 percentage points will be for growth initiatives, such as the setting up of ECN and climate-related initiatives. And 3 percentage points will be for continued investments in the faster-growing subsidiaries, Scientific Beta and BidFX. As for the remaining 4 percentage points, they are for expenses relating to our underlying core businesses, which you may call BAU expenses. As you are aware, as a critical market infrastructure, SGX has to continually invest to maintain our resilience. If we look over a 2-year trend between FY20 and FY22, our underlying core business expense, excluding Scientific Beta and BidFX, that is, would show a growth rate of 1.5% per annum. This takes into account the expense growth associated with the investments I just talked about, such as the ECN. So it is not just about BAU expense growth. In other words, what I've included is the 6 percentage points increase, which I've highlighted in red. Underlying core expense in FY20 was $475 million, after excluding $12 million of expenses from Scientific Beta. It further declined 4% to $458 million in FY21. If you layer on the 6 percentage points, the increase I've just talked about, you will be able to work out the math, which equates to 1.5% per annum growth over the 2-year period. The expense guidance I'm sharing today excludes transactions that have been announced but not completed, such as the MaxxTrader acquisition. As the completion date is not certain, although we do expect the deal to complete in the second quarter of financial year 22, the inclusion of MaxxTrader is expected to add a further 25 million of growth expenses in the new financial year. This is an annualized basis. Our expected CapEx spend in financial year 22 is consistent with our growth aspirations. CapEx for FY21 was $51 million, $10 million higher compared to the previous financial year, but $4 million lower than the guided CapEx range for FY21. We will invest more in FY22. CapEx is expected to be between 60 to 65 million as we grow our fixed income and FX businesses, as well as in partnership initiatives. We will also continue to improve the resilience and upgrade our infrastructure. We introduced the adjusted EBITDA and NPAT in FY21 to provide the market with greater transparency on certain items such as the one-off and non-cash items. Looking at the adjusted metrics for FY21, they were comparable whether they are on the adjusted or the reported basis. The full table of reconciliation between the metrics are set out in greater detail in the SGX net results release. But one thing I would like to highlight is the inclusion of a $10 million earn-out contingent consideration for BidFX. This is a non-operating expense item which has an impact on our FY21 earnings. In other words, if we did not make a provision for this one-off item, earnings would have been $10 million higher. Let me explain further this earn-out structure. When we acquired BidFX a year ago, we put in place this structure to de-risk the transaction for SGX. Rather than pay upfront this amount, regardless of the actual calendar year 21 revenue performance, we agreed that we would only do so should BidFX meet certain predetermined revenue targets. In other words, we pay less upfront and top up only if BidFX outperforms. At this stage, we are halfway through the calendar year. Given BidFX revenue outperformance in the first half of calendar year 21, we have decided to make an additional provision of $10 million. This number is not a final number. The final actual payout would depend on the actual calendar year 21 revenue number. The fact that we are making such a provision at this stage means that the value of the business has grown. Our estimate is that the value of BidFX has increased by 15 to 20% of our initial investment value, exceeding the additional contingent consideration. You will have read from today's announcement that Moody's has assigned a rating of AA2 to SGX. This is the highest rating that they have given to any exchange group. Our robust credit fundamentals at the group and clearinghouse level have always been known to our customers, clearing members, and stakeholders. Our leverage levels have been low. Our interest coverage ratio has been very healthy, and we have strong cash reserves. What the Moody's rating adds is a strong affirmation by an independent and credible third party. So not only does it demonstrate our strong fundamentals, it also reinforces our risk management value proposition to customers. Looking ahead, assuming that the acquisition of MaxxTrader is financed solely by debt, our gross debt to EBITDA ratio would be at 1.1 times, still at a healthy level and low compared to some of our peers. The Board of Directors has proposed a final quarterly dividend of 8 cents per share. If approved at our AGM in October, the total dividends for FY21 will be 32 cents per share, or 5% higher year on year. As you can see, our operating cash flow, our adjusted earnings per share, more than cover the dividends we will pay out to our shareholders. The free cash flow that we retain after paying out our dividends will be used for capex, investments, and to build up our cash resources. As I mentioned at the Analyst Day, we are focused on total shareholder returns, a combination of earnings growth and dividend yield. As we drive earnings growth, we intend to put in place a scrip dividend scheme to offer our shareholders a cost-effective alternative of participating in our medium-term growth journey. Such a scheme would give them an option to reinvest their cash dividends in SGX shares. Let me be very clear. The intent of the scrip dividend scheme is not to shore up SGX's financial resources to meet any near-term liquidity requirements. We will provide more details of the scheme, including the timing in due course. And for the avoidance of doubt, this scheme is not intended for the final quarterly dividend proposed for financial year 21. Now let me hand over to Boon Chye, who will deliver the business update.
Good morning, everyone. Thank you for joining our FY21 year-end results briefing. I would characterize performance in FY 2021 as a strong one as we advance SGX as a leading international multi-asset exchange. Our strong core businesses of equities, FICC or fixed income, currency and commodities, together with DCI, data connectivity indices, plus the new growth engines and emerging opportunities enabled us to serve our customers well as they seek growth opportunities in Asia. Not only have we grown our revenues from about 780 million in FY 2015 to 1.05 billion today, we've also diversified our revenue streams, with FICC and DCI contributing 34% of revenues in FY 2021. At the same time, we have invested by acquiring faster growing businesses such as Scientific Beta, BidFX, and more recently, MaxxTrader, and seeded emerging opportunities such as a digital fixed income marketplace known as the MarketNode, and in nature-based sustainability solutions via Climate Impact X. For our core business, starting with cash equity, I would like to highlight 4 areas. First, in meeting the diverse capital raising needs. The SGX capital market is an enduring one as we help companies raise capital across the economic cycle. Companies raising, on average, 4 times more in secondary fundraising. Looking at some of the listings in FY 2021, which cut across a spectrum of different industries, the performance of some of the new main board IPOs in FY 21 have been positive. Looking at the chart on the left, you would see that Nanophone's market cap more than doubled, and its turnover velocity was almost 150%. And in Aztec Global, the turnover velocity was almost 300%, and its market capitalization was up 20%. This has engendered good interest from issuers, as well as providing investors with a wider spectrum of companies and sectors to invest in. We see a strong pipeline of mandates in the current financial year. We have also completed our consultation for listing SPACs, or Special Purpose Acquisition Company, and that is undergoing regulatory approval. Second, we have broadened our investment solutions by expanding the securities product shelf across asset classes and geographies. And you heard from Yao Loong earlier, in ETFs, AUM increased by over 60% from last year to reach almost 10 billion Sing dollars. And new ETFs that were launched has also seen growth in AUM. More launches of ETFs are in the pipeline, and we hope to continue with the momentum. Third, we provided new and enhanced post-trade services and supporting trading activities with improved settlement workflow. The revamped securities borrowing and lending program saw a 17% increase in outstanding balance to reach close to 60 million Sing dollars. Fourth, as Yao Loong has said, we expanded participation in the market. Our revamped market maker and active trader program has close to 40 participants. There was also healthy growth in regional retail participation from ASEAN. In derivatives, it was a strong performance in a year of transition, where we successfully conducted a world's first liquidity switch of benchmark equity indices contracts to FTSE. We also expanded our product shelf at the same time and introduced ESG versions of certain composite and country indices, such as Emerging Markets Asia ex-Japan, Emerging Markets Asia, and FTSE Blossom Japan. We've also launched a new asset class in Nikkei Japan Green REIT. We complemented our China A50 with the launch of China H50. The FTSE China H50 is a liquid basket of stocks tracking the top 50 biggest Chinese names that comprises H shares, red chips, and P chips that are listed in Hong Kong. We now can provide investors a comprehensive access to Greater China and its fast-growing new economy sectors in both the A-share and the offshore market. One such notable example of the competitive advantage that SGX has from the very strong network and portfolio effects of our ecosystem was the launch of the Asia ex-Japan Net Total Return Futures in just under 1 year. Starting from zero, our open interest is now 2/3 of the global Asia ex-Japan NTR market. Moving on to growth engines. Starting with the faster-growing FX business, we are investing to build Asia's largest integrated FX platform with the acquisition of MaxxTrader, and we hope to complete that in the second quarter of the financial year. Our FX average daily volume would reach $75 billion. In our FX futures market, not only did we receive industry recognition, we notched several records last year. For example, a record single-day volume for the Indian rupee dollar futures that reached almost close to $4.5 billion. Similarly, a record single-day open interest in the same rupee contract that reached almost $4 billion. And in CNH, the open interest reached $11 billion. So having established ourselves as the largest and most liquid FX derivatives exchange in Asia, we expanded our product offering further. We launched several other contracts, largely in Korea, the Korean won, the Sing dollar, making it larger size, and also launched the Indian rupee Quanto contracts and options, and also introduced the mini contract version of the CNH. Also very pleased to report that there's been good progress in BidFX. Yao Loong mentioned the provision of the $10 million, and that's because BidFX has outperformed its revenue targets that were set. And also, the number of active users are up close to 30% at the end of the financial year. And average daily volume has increased by over 60% to close to $40 billion. With the acquisition of MaxxTrader, it will broaden our client base to over 200 institutional clients, covering the full spectrum of the buy side and sell side. We will also leverage MaxxTrader's technology to set up the ECN, Electronic Communication Network, FX Marketplace. This ECN FX Marketplace will provide so-called all-to-all anonymous trading. It will offer our clients a full suite of FX futures and OTC solution coupled with low latency access and price discovery anchored in Singapore, Asia's largest FX trading hub. In our index business, We accelerated product development through Scientific Beta's research pedigree. We will be partnering asset managers and banks to launch thematic products and ETFs. The Climate Impact Consistent Indices is a new product that has been launched, and it caters to the growing demand from asset owners to meet their net zero emission commitments in the year ahead and beyond. The alignment between portfolio construction for investors and the climate performance of companies is increasingly a key focus in the investment world. Scientific Beta's new CICI series provide the closest alignment between constructing a portfolio and the climate performance of companies, and that is in line with net zero investment frameworks. And as it gains adoption with asset owners, we hope to scale this in terms of asset under replication. Moving to another area of growth, and that is in fixed income. We are developing a digital marketplace covering the full life cycle and leveraging on our strength as a global exchange for Asian bond listings. We are home to issuers from more than 60 diverse industries across 45 countries and have a leading market share in G3 APAC bonds with a 44% market share. And building on this strength, we are developing a digital fixed income marketplace for enhanced workflow and customer experience covering the full life cycle of fixed income securities. In Market Note, it is a JV that will provide digital asset primary issuance coupled with post-trade and asset servicing. And we will provide global access to Asian ESG bond data via a partnership with Nasdaq in the Nasdaq Sustainable Bond Network. And this will cover green, social, sustainability fixed income securities. And in trading, we will provide global access to Asian bonds via our joint venture in Trumid XT. It will enhance liquidity and execution of Asian bond trading globally. And in the post-trade, we will digitize that and partner up with other CSD and ICSD for Singapore-based settlement. And as the world deals with climate change, we are leading the way as an Asian exchange in sustainability to build a resilient future. Our vision is to be the leading capital and trading hub, enabling sustainable finance and credible transitions with end-to-end products, solutions, and ecosystems. We have recently demonstrated our commitment by being the first Asian exchange to commit to 1.5 degrees Celsius aligned science-based emission reduction targets. Corporates and investors are making their voices heard. They are embarking on a decarbonization path. And as they do so, a few things have to happen. One, they will have to measure carbon footprint, set emission reduction targets, reduce absolute emission, neutralize the unavoidable residual emissions, and also on a year-on-year basis, compensate and report progress. And what does all this mean? It will lead to opportunities in debt and equity financing And today, SGX already provide green, social, sustainability, and sustainability-linked bonds. We will provide platforms for listing of infrastructure and decarbonization funds. And today, we provide renewable energy certificates via EMC, our subsidiary, and in future, carbon credits via Climate Impact X. And in the area of investment and risk management solutions, the launch of Climate Impact Consistent Indices, ESG version of benchmark derivatives contracts, and also we'll be launching ESG exchange traded funds and other products. And not forgetting data, the NS Bond Network or Nasdaq Sustainability Bond Network partnership, and also we'll be launching a ESG data portal. Looking ahead, and you heard from Yao Loong, we announced a rating of AA2 by Moody's, the highest assigned to any exchange globally, reaffirms the strong credit fundamentals of SGX and our clearing houses, and also reinforces our risk management value proposition to customers. We are well poised to help our customers capture growth opportunities in Asia and capitalize on trends in digitalization, sustainability, and passive investing. And in so doing, we will become the largest Asian FX integrated platform. We will also provide a digital fixed income marketplace covering the full life cycle, and will be the leading capital and trading hub that enables sustainable finance and credible solutions. So we'd like to thank all our stakeholders and shareholders for being on this journey with us. The journey continues and exciting times lies ahead. With that, I conclude my presentation and invite participants to ask any questions that you have. And I have my management team with me, and also like to introduce Paul Levin, which you all can see on your screen. Paul is our new head of global sales and organization. He joined early July and spent 20 years at Goldman Sachs. Thank you.
So, ladies and gentlemen, we will be commencing the question and answer session shortly. So, as Boon Chan mentioned, the list of panelists is being flashed on the screen at the moment. For invited analysts and media representatives, just as a reminder, if you have a question, please click the raise hand button to ask a question, and we will centrally unmute your microphone so that you may speak. Please remember to click off the raise hand button when done. So can I invite the first question, please? First question from Gurpreet Sahi from Goldman Sachs. Gurpreet, please proceed.
Thanks, Dominic, and thanks management for taking for walking us through the presentation and giving me the opportunity to ask a question. I have two. If I may please go one by one. The first one is on the cost side. So Yao Loong walked us through the cost. Seems like cost can rise nearly 9 or 10% this year. How confident is the management around the revenue side, given it's subject to volume and market price movements, that this year we can still have some growth on the earnings? So that's the first one.
Yeah, let me take thanks, Gurpreet, for the question. Yao Loong mentioned the provision of additional 10 million for BidFX. So clearly they have outperformed our original expectation of the revenue. There's also been good momentum in terms of the increase in active users. And third, there has been good cooperation synergies between our sales organization in cross-selling. Some of this obviously take a cycle of 3 to 6 months, but there have been cases where we've onboarded new clients onto the platform. And depending on when we close the acquisition of MaxxTrader, we like the technology, we like the client base that they have, and that will just give us a holistic platform to offer clients access into the FX market, which is clearly and equally important and continues to grow as an asset class. So the momentum is there.
Okay. And then the follow-up is on dividend. The bring back of the scrip, we acknowledge that it's not for this fourth quarter dividend. But then given that there's been 3 transactions, and going back to what we were discussing when the MaxxTrader acquisition was being discussed, 3 transactions, the leverage is raised, although it's very comfortable compared to peers, and you have a very good credit rating. But this just signal to us that the management wants to keep some earnings in-house after doing these things. So what's your view, Bunchai, on how should we think about in the very near term incremental bolt-on acquisitions if opportunity does arrive? And I'm thinking more like 6 to 12 months.
Yeah, so on the scrip dividend itself, let me reiterate what Yalong said. The business is very cash generative. If you look at the balance sheet, the free cash flow increased by almost 150 million Sing. I mean, net of payment of all the expected dividends for the financial year. And we will continue obviously to offer 100% cash as dividend for shareholders. And looking at even if we do fund MaxxTrader 100% on debt, it is still a healthy 1.1 ratio on leverage. That still gives us sufficient room if we were to take on further acquisition. But I think what is important is the acquisition has to have a strategic fit. It has to, in areas, add new capability, new capacity in terms of clients. And we're comfortable from our businesses and with the strong balance sheet to be able to look at different sources of financing. That is just one area, and there's still a lot of room that we can tap if there are interesting opportunities that could scale. And obviously, that will add revenue, and that also depends on the potential target in terms of the cash generating capacity.
Thanks. And finally, just checking that the next dividend raise cannot happen before the fourth quarter of next year. That's right. That's correct? Or within as you report first or second quarter also, there's a scope to raise dividend?
If you look back the last, call it 5-10 years, you have seen how our dividend history has been. There's been increasing steadily, and as I always said, we like to pay a growing dividend in line with the growth prospects, medium-term growth prospects of SGX. And I hope we demonstrated the track record, not only in terms of dividend, but in growing the scale and breadth of our businesses.
Understood. Thank you very much. All the best.
Thanks, Gurpreet. So the next question is from Rui Wen from DBS. Rui Wen, please go ahead.
Hi, good morning, Bunchai and Yalong. I have 2 questions. The first question would be that, would you be able to guide us through your thought process about how earnings may actually grow on a more sustainable basis from here, given that I guess market appreciates the effort by management to bring in growth engines to kind of grow the FICC revenue, but we are also against a kind of more volatile derivatives revenue that might be more unpredictable. So any thought process about this earnings trajectory in the next 3 to 5 years would be helpful. Second question, by any chance, are we even thinking about a discount on the scrip that you are considering? Thank you.
Okay, so go ahead.
Yeah, I'm just going to take the second question first.
Yeah.
I think it's premature to talk about the the discount. We have yet to decide the timing of the scrip dividend. But if you look at precedents where different issuers have issued scrip dividend, I think you can see that the discount rates do vary. Some are from 0 to 2%, and then some are clearly in the higher end of the range, closer to 10%. What I believe is that we have an attractive growth story. And what we are providing is an option for investors to participate in a very cost-effective way, to reinvest and grow together with us. So it's a total return story. And so my view is that we will be likely closer to the region where the discount is at the lower end. But again, that is something we have to decide, because it's about a total return earning story. It's not about shoring up our liquidity needs.
So thank you for the question. Maybe let me start off with the point that Yao Loong was mentioning at the start of the results briefing. If you look at the underlying businesses, it actually grew 7%. And obviously, low interest rates had an impact on treasury income, and that is 100% margin. Every single dollar of treasury income drops to the bottom line. So we can talk about a low rate environment, but the flip side of it is the low rate environment really means investors have to find means and other sources of return. And as the markets now talk about, and it's a divided view, inflation expectation. Is that transient? Is it permanent? And we also have central bank officials, in particular in the US, now talking more about when is tapering, right? Is the first hike going to be in September? Sorry, not September, in 2023. So that really means assumptions on certain interest rate trajectory. But I think more importantly to your question, how do we see earnings revenues on a medium-term basis? There are a few areas. So the core underlying is strong, and we'll continue to grow that with strong discipline on cost management. And if you look at the FX market, we are now putting together two OTC platforms that has combined the clientele of the buy and sell side, and also a pricing and risk management solutions for participants on the platform. And the FX market, if you look at the BI survey, has been growing for the last 20, 30 years and continues to grow. And if you're investing in Asia, the FX component is a consideration, not just purely in terms of hedging, but also in terms of a potential return as an asset class. So we see good momentum in that, and as we put the platforms together with a broader client base, our outreach will be growing. And then two, in scientific beta, not only do they have a strong core offering of smart factor strategies, the addition of climate solution will be the extra pillar the asset owners will look at. And AUM or AUR, asset under replication, is pretty sticky over a medium-term cycle. And I think that is something that not only will allow the revenue to continue to grow, but also allowing us to find synergies with our very own IH in terms of launches in thematics, with asset managers in ETFs. And also building on the fixed income platform strength, which no doubt is largely listings today. We hope to launch the Trumid XT platform in the months ahead, and we're seeing at least continued traction as we market the new platform with a general counterparty capability. Then obviously, not forgetting that in our equity business, we demonstrated the strong portfolio network effect of how we could not only just retain liquidity, but grow new liquidity. That's why I took a little bit of time to try and explain the launch of the Asia ex-Japan net total return product. Starting from zero, we've been able to grab and gain market share. I hope that answers your question.
Thanks, everyone, for the question. There's a question from Nick Lord from Morgan Stanley. Nick, please go ahead.
Hi, thanks very much for taking my question, and thank you for the presentation. A couple of questions from me, actually, just to return to two things we've discussed. First of all, on the scrip, and I hear everything you say about, I think this is, or my read of this is, but this is for investor convenience rather than for your own cash flow needs. So I guess two questions related to that. First of all, would you consider buying back shares to neutralize the impact of the scrip? And secondly, or do you sort of, after 3 or 4 quarters of offering the scrip and you know roughly what the scrip take-up is, do you use that as a way to push up the dividend so that the cash flow is the same, or the cash impact is the same as it would have been otherwise? So just asking about how you manage that extra cash, you would say, from the dividend. And the second, just on the costs, I mean, you obviously flagged at the investor presentation that cost growth would be higher going forward, and there's investment taking place that you need to do, and that's why the costs are higher. And I guess relative to expectations, the step up in the costs for 2022 is higher than people were expecting. So are you just trying to front load this investment such that we return to a more normal cost growth phase in 23, or how should we be thinking about the sort of the projection in terms of costs in 23 and 24?
Nick, thanks for the questions. I'll take both questions. I think first, we spent quite a lot of time a few weeks ago to talk about our medium term, right? Because as we are at the results, we tend to focus on a year-on-year. We are investing in growth, and that's why you see significant expenses in FY21 and FY22. And this will lead to revenue outperformance. And so this will scale out our margins. And so over a medium term, we have clearly stated that what we expect expense growth to be will be in the mid-single digit region. And the margins, as a result of that, will scale back to the levels that we see in FY22, which is closer to 62% for EBITDA margin. So that, in a way, shows the investments as we grow and we get the revenue that will impact the margins and improve the operating leverage of the overall business. And one thing that I'd like to point out is also that the quality of the revenue profile as we grow, driven by FX and a few other things, right? The combination of the non-equities business, which is FICC and DCI, will constitute a larger part of the overall revenue share, closer to 40% over the medium term. In terms of the scrip dividend, we are in a growth mode, right? So again, the scrip dividend is to allow shareholders to participate in our medium-term growth journey, where they believe that by reinvesting their dividends, their cash dividends, they can participate in the overall total shareholder return or a higher earnings growth. So it would actually defeat the purpose if, on the other hand, we do a share buyback on the other hand. As for the future direction of the cash dividends, I think the commitment that we have articulated remains. We will pay a growing and sustainable level of dividends based on the earnings profile of our business, which we expect to grow over the medium term. So that remains unchanged. As I said, the scrip dividend is to allow shareholders to join us in this journey, and it is a cost-effective way of doing so.
Can I just sort of come back? I mean, on both those points. So on the last point, and I'll hear you on share buybacks. So when we think about dividends going forward, should we be thinking about cash dividend paid relative to cash flow, or dividend declared relative to cash flow? So if I'm looking at cash flow cover of dividends, should I be looking at the cash versus cash, i.e. what you actually end up paying out, or should I be looking at cash versus declared?
Sorry, Nick, can you clarify? Can you say that again?
Well, obviously, you're going to have a dividend, yeah, which will be X cents a share, 32 cents. Yeah. And we can look at that. We typically look at that as cash flow cover of the dividend to see how affordable that dividend is. But let's say that you end up having a 40% take-up of scrip. Then, and if I look at other companies who have a scrip dividend, within a few quarters, you can have a pretty good guess as to how much the scrip take-up will be on because it tends to be reasonably consistent, and you can flex discount to increase or decrease that. So when you're thinking about your dividend payment, will you be thinking about the declared dividend relative to your cash flow, or what you know by modelling it would be the cash outflow from your dividend relative to your cash flow?
The dividend, the cash dividend that we will be thinking about, is independent of the scrip dividend and the take-up rate, because that's at the election of the shareholders. So some shareholders will take up and some will not. So for the cash dividend, it will remain committed to the policy, and that will be independent of the take-up rate of the scrip dividend scheme.
Okay, so you will take into account the take-up rate when setting the cash dividend, or when setting the declared dividend?
No, I'm saying that those two things are independent.
Okay.
Yeah.
Okay. All right. And then just in terms of costs, I mean, you speak about medium term, and I do remember for Investor Day, I can't remember, apologies, exactly what it was, but you gave a definition of medium term. And I can't remember, 2 or 3 years or whatever.
Yeah. Okay. You know my answer. I'm going to say that, right? I'll tell you what medium term is by defining what it is not. Short term, anything to do with 12 to 18 months. Longer term, anything more than 4 to 5 years. Anything in between is medium term.
So when it comes to this cost step up, we've got 8% costs sort of flagged for next year, which is obviously higher than mid-single digit. Are you thinking that could be for the next couple of years, so in 22 and 23, or do we go to about mid-single digit in 23?
It will be over a period. Medium term, let's say if we take about 3 years, so that will scale down clearly. It will not remain at the 8% as we scale over the medium term. So it may be some parts of it in FY23 and some in FY24. But clearly, you're asking me to give a very, very long-term outlook.
Yeah. I'm just trying to get a feel about anything.
But mathematically, it will have to scale.
Yeah. No, that's clear. Thank you very much.
Yeah.
Nick, if I may just add, if you look back over 3-4 years now, we've been able to grow our businesses, and we've been able to grow our revenue, and we've been able to grow our dividend. So on the point about scrip dividend, you can't quite tell what the take-up rate is because it's still gone with 100% cash, and it's not an exercise to try and boost up the balance sheet. We have gone with purely 100% cash dividend still. And the fact of the matter is, I think as a company we perform well, and investors may want the choice of reinvesting in a more effective way. And also we have been able to fund the expenses with growth. So yes, all you would like to see a sustainability of growth of the revenue. I just hope that management and our colleagues at SGX and I as the SGX Group have demonstrated the capability to execute and deliver.
Thank you.
Thanks, Nick, for the question. The next one is from Harsh from JP Morgan. Harsh, please go ahead.
Hi, thanks for the call. One thing on the scrip I'm unable to understand. If it is truly for just shareholder convenience, why not commit to a zero discount? Because if there's any discount, you are effectively doing a mini rights issue and you're forcing investors to basically take stock. And then given your current capital position and last 2-3 years of efforts to shore up capital, it then starts making us ask questions on whether why is that capital for and all of that. Given the track record has been good, but again it kind of starts stretching that point. So if it is truly for just shareholder convenience, can you commit that it's a zero discount scrip?
I think it is too early at this stage to comment on discount. As I said, there are 2 categories of companies. One where they need the liquidity to show up their capital, and those tend to have higher discounts, right? When we look at precedents. And we look at those, and there are companies with 0% discount to very, very small 1 to 2%, right? And those allow their shareholders to participate in their medium-term growth story. At this point in time, I do not want to commit whether there will be a discount or whether there will be a 0% discount. But what I know is that it will not be at the higher end of the range, if any.
Okay. No, because the stock is down 4% onto the announcement. And one of the biggest question marks, which I'm getting at least in the last couple of hours, is the dividend, scrip dividend. So just one feedback. Now, second point, a bit of a more mundane questions. There were some kind of losses. One was on impairment loss on investment in associate companies of 2 million. And also there was a swing in other revenue from gain to losses of about 2.5 million in second half. What were these two line items? What drove these two line items?
Okay, the first impairment loss, it is a write down in this FY of one of the associate companies of about 2 million. Last year, 6.2 million was for Fritos, and this was the 2 million this time around was for Cadbridge. And your second question was regarding the other revenue line, right? The interest income. Yeah. So one thing which again, that line has two items. I think I've explained the contingent liability of the 10 million. And the other one, when we talk about low interest rates, it has actually also affected the interest income from our own corporate cash reserves, right? And so as a result of the lower interest rates, that has also come down significantly. So investment and interest income on our cash reserves have actually declined by close to $8 million when I compare that on a year-on-year. So you will see that the non-operating gains, you do have the contingent liability, and then you do have also the interest income impact from the lower interest rates. But that's on our corporate cash.
Right. So this 10 million of contingent, this thing, we should take it as a one-off and that's it, right?
Yes. By accounting rules, it has to be treated as an expense item. It is below the line. But as I said, if we actually paid this amount upfront, rather than structure as earn-out, it would have been capitalized and not as...
You would have been capitalized,
right? So, yes, it is a one-off, and it has to be seen in the context of revenue outperformance by DataFX and value creation as a result of that.
So effectively, if you actually don't write it back, it's net positive. It means that BidFX has outperformed your expectations or whatever, has performed well. Either that happens or you write back some part of it.
So what I'm saying is that by the end of the calendar year, when we have the exact revenue of BidFX, we will be able to make that final determination of what the final payout would be. So again, there will be just adjustments. It could be up or down, depending on the actual final performance. What we have done now at this stage is to take a view based on what their first half calendar year results are, what their second half calendar year results could be, and make that provision.
Got it. Okay, thank you. That were all.
Now, Harsh, if I may just add, look, we could either pay a lot more upfront in an acquisition based on forecast revenue, but one way to look at it, which probably is a lot better for our shareholders, is to have earn-out based on hitting certain milestones, and that frankly would have been at better valuation at the outset. And on your point, which I know is a reaction in the last 1 hour, in terms of the scrip dividend, if you look at many of the corporate history, the take-up rate isn't very high. And we could have, as I said, really gone with 100% still cash dividend. Our engagement with investors over the last 18 months has really shown us that they like the journey they are on. They see the path forward and growth and scale. And we just want to offer an additional avenue where they could reinvest their dividend. If not, they could also elect cash.
No, I agree, Boonchai, and in fact that's very fair, and I fully agree that it's a cost-efficient way. But then it'll be clearer if you could commit to a zero discount. That's it. Because if you start putting in any kind of discount, even if it's small, it then starts making people like us second guess as to is it really just as a convenience or there is some underlying reason for retaining capital. And it is not for anything else, because if you look at last 3 years, you have gone from, let's say, 90-odd% payout ratio to a fixed 8 cents per quarter. And now you're putting in dividend, scrip dividend. If I start fitting it into a pattern, it starts making me question. And if you commit to a zero discount, then I won't go that path. That is all. But I fully agree with what you're saying. Thank you.
No, we hear that, and I think that's what some of you have asked questions around that. I would say, as Yalong mentioned, it's still early for us to formulate it. Our intention is really for investors that have stayed with us, investors that have come on in the last 2 years. We'd like you to have convenience to continue the journey with SGX, because we're now an expanded group.
Okay. So thank you very much. We've come to the end of the briefing. So to those who have asked other questions or have more questions to ask, please feel free to direct them to the investor relations team at SGX. So we thank you for your participation and have a good day ahead. Thank you.